essentially the equivalent of counting cards at a blackjack table. So I presented a video earlier called "A Day Late, a Dollar Richer" on essentially following the issuance of these products. If you're unfamiliar with myself, I'm a whistleblower with these in regards to these and several other structured products. I believe they're mathematical constructs created to defraud investors. And a lot of people say, well, people are betting on these on their own accord. The disclosures are robust, and really it's degenerates who are risking their savings. No, that's not the case. These are being funneled into what I call managed money accounts, or advisory accounts, pension plans, defined contribution plans, otherwise known as 401ks, endowments, sovereign wealth funds, large pools of capital where these products can be placed. The advisors can be paid a fee, commissions, rebates, other direct and indirect compensation for holding these on behalf of clients that have no idea they have them, while these products slowly decay. Why is that important? Well, the issuers of these products and their Wall Street counterparts, who are providing the leverage factors of swap agreements, are essentially selling something for 100 that they know mathematically will be worth 40, 30, 20, 10 dollars at a later date, in which they benefit. They keep that spread. There's never a chance for regular investors to take a portion of that money, because these products don't purchase options or futures. The performance factor on them is strictly swap agreements. And if you look at the inverse products, they are solely swap agreements. The leveraged long products do have a small portion that are held in underlying stocks, which gives a little boost to the stock price. And then when the other side that's issued does not short the shares, you get a double benefit. You kind of pump the stock price of the underliers, while also having mathematically the decay from the way these products are structured. So brief recap, just to follow along. This is something everyone can follow along and bet against if they so choose. So in the previous video, I talked about how to pull up the NAV history from ProShares' own website. So we're just going to look at SQQQ. It's the only one I'm going to focus on. It's the most profitable for ProShares out of any product they issue, and it's the most profitable leveraged product through the lens of Wall Street currently in existence. So if you click on NAV history and download, it's going to give you a spreadsheet. This is the spreadsheet. So I'm going to walk you through a little more in depth as to what I do to bet against these products. So I bet 1/100,000th of the issuance. So when 100,000 shares are issued in this product, I would sell short one share. And when 100,000 shares are redeemed, bought back, then I would buy that same equivalent back. So all we need to do is look at the delta, the change in the share count day over day. So we take what was issued on 5/12, the shares outstanding, minus the shares outstanding from the previous day. We see 6,400 shares. Remember, this is 1/1000th of the actual shares that are outstanding, the actual share count. So the true amount of shares is this times 1,000 that were issued. So 6,400,000 shares. I'm gonna sell short 1/100,000th of this. So it'd really just be this number divided by 100. So 100. So 64 shares. Because the share count went up, that means it was issued to the public. I'm going to do the equivalent of that. I'm going to sell short 64 shares. So if you do that over time, we would see that really, since this product bottomed, we see something very strange. The product bottoms and it, excuse me, I apologize. This product, the market bottomed, and this product suddenly has huge demand to purchase more of this product. But as the market was going down and this product was actually benefiting the holders, funnily enough, the amount outstanding went down. It's counterintuitive. It's following the opposite logic of what anyone would do. If you look at this counterpart for TQQQ, you see that there's huge, massive issuances. TQQQ went from $90 to $37 and then magically, when it hits the bottom, more product is issued. More product is redeemed, not benefiting, not going with logic for these products. So my team and I created a model where anyone can kind of follow along. So we can see that over the past month or so, we see that we would have about 408 shares that we would be short, and some of these would have lost money, some of these would have made money. So let's go to the dashboard we created here to follow along. So on the website fraudresearch.com, we're going to go to the day late dollar richer. This is just SQQQ. I'm trading this live. These are real trades. This is just a dashboard we created so that I don't have to open up my portfolio. So we see that since I started this, after this dashboard was created on March 12th, we can see that on that day I shorted 18 shares. So let's go to the spreadsheet and just double check that. So March 12th, we have 18 shares. So it's important to note that when this spreadsheet comes out, I'm trading a day late. So on the 12th, I'm trading, and I rounded up. I shorted 18 shares. 1/100,000th of the amount of shares that were issued was 17.5, round up 18 shares short. And I did that every day since. So if we go back to the dashboard, we can see all of the trades, all of the short positions, and their subsequent gains. So on that day, it was 18 shares. The cost basis was $36.97. The current price is $28.61. Market value was $514. I gained $150 on that, 22%. So we can see that all the way down. I do this once a day, one trade a day. There's no rhyme or reason to that I'm doing here. Sometime during the day, I look, calculate, see how many shares were issued, and I trade 1/100,000th of that. So the cool thing is, we see that if you just would have done that, very logical exercise of I'm gonna assume for a moment, and this is what I do, I assume for a moment that I'm right, that this is a fraud, that Wall Street knows what they're doing, and they're better at math, and they're better at distribution, and really they're there to make money. I also take the assumption that these products wouldn't exist unless they were highly profitable for Wall Street. So just with some simple assumptions, I think to myself, and it takes a little bit of humility to do this, I'm just going to follow along with what Wall Street does. So that's essentially what I'm doing. I don't have billions of dollars. I don't have millions of dollars. So I scale down the proportion of what I'm betting against. And I understand we're looking at one product here. If you read my book, if you look at my SEC filings, you can do this analysis over every single product that has ever been issued over any time, and it holds consistent. In aggregate, meaning if you view Wall Street as selling SQQQ, which might be a 7-Eleven selling, Red Bulls, which is highly profitable. They're also selling bags of ice that have low margins, or penny candies that have low margins as well. So you have to look holistically at all products if you're looking at exposing the fraud, or you want a risk-adjusted portfolio that really has low variance and low volatility. For the purposes of this exercise, I'm trying to spark an interest in you to look at further of my research, to look at this in the lens that I look at it. So I'm just looking at the most egregious. If we follow this over time, the mathematics on this product decay extremely rapidly, and we won't go into that now. Once again, everything I'm going to share publicly is already in the book, and maybe I'll expand upon it. But here's all the trades that would have happened if you just followed that simple model. When the issuers issue shares, we're going to sell short. The cool thing is, SQQQ now, at this time, at least with Fidelity, does not have a borrow fee. So this is a free trade. Follow along, and then the long positions. There are days that you have redemptions, and those get redeemed. So on the 13th, we had 5 shares, which is 1/100,000th of the issuance for that day. And I bought those shares at cost basis $38.85. The current price is $28.61. Market value from the original trade was $143.05. The gain loss was $51, or 26%. So my claim is that this mathematics only works if there's something nefarious going on. But the nefarious part that's going on should also kind of be logical. If we allow Wall Street to issue something for 100 that they know and have mathematically construed that will be worth 40 in the future, and the SEC helps facilitate that through regulatory capture. You have political capture as well from those in the Senate and the House that believe that these products are financial innovation and not fraud, you really have no protection except for a guy named Rob Bezjan who's screaming into the void by himself for now. But because these products are traded in public markets, my research can be tested. It can be back tested. The mathematics, if anyone cares to look at it, which you'll never get an academic ever to validate or even opine on what I'm saying, because they are paid by those. They know that their careers would be ruined. They would never be an expert witness. They would never do any research for Wall Street. Their time would be limited. So it's going to be the little guys that validate this on their own. Until then, every day I'll be screaming into the void. But I'm happy for you to follow along. You can follow along on your own, like I just demonstrated. If you want to pay $5 a month, you can follow along with this model, and we'll expand it later. That $5 goes to my very wonderful team who built this for me. I'm not a coder. That's not my expertise. I'm a spreadsheet guy, old school, and I don't care to learn new things. It's too much. So they were kind to put this together. So we see on the long position, we'd have 277 if the positions didn't net out, right? We're just aggregating everything here. I obviously don't have 277 shares long at this time and 708 shares short. I just have a net position of 441 shares short. But if we look at the net, we would have purchased a total value of $7,638 long based on 1/100th of the redemptions. The total loss would have been $3,270. But on the short side, once again, we have a total value of $20,000 with a total P&L of $5,000. When we net this out, we have a total gain based on the netted positions of $1,700, which represents an 11.71% return just from March 12th off of a $14,700 total exposure at this moment. Now, this is because we're looking at one product, it's going to be very volatile. But if I was going to make a recommendation, if you followed along with what I just said and you did that historically, and then know that the mathematics are construed that the future will actually match the past, closely match the past, just like blackjack, right? You have no idea what the dealer's going to hit, but you know that over so many hands dealt, the average of a dealer getting a blackjack is 1.7% or whatever it is. Same thing goes with these products. We don't know what tomorrow is going to bring, but we know that the mathematics behind them are designed, approved, construed, distributed to benefit the issuers in a very profitable amount. So I had maybe we'll go over this again real quick. If we want to look at the total issuance of these products, we can see that there's roughly $3 billion in current net assets in this product. And if we went and did an average from the entire time period from inception, we have about 1.2 billion. Now, I did this in another video, so I'm not going to redo it, and I would love for you to do it yourself. But if you netted the net issuance, so how many shares were issued, what price were they issued at, minus the net redemption. So what was the aggregate amount redeemed, and what was the price? You get about $16.8 billion more being issued to the public than what was redeemed, and a current outstanding net assets of $3 billion. So that means roughly 14 billion, 13.6, 0.8 billion of net profitability for this product. That's solely based on math, has never held a share short, has never bought an option, only has swap agreements with Goldman Sachs, JP Morgan, Nomura, Citigroup, et cetera, which means that money is coming into it somewhere in Wall Street through ProShares, through the issuers of these products, through the distribution chain, the advisors who are getting paid a fee, which is disclosed. The fee amount is not disclosed, but there's a fee that is disclosed that they receive, which should be looked into, by the way, from journalists. Journalists should look into this. You want to find fraud, follow the money, follow who gets paid. But it's hard to argue against. I'm showcasing the most profitable product for ProShares, $13.8 billion of net profit based on math alone that went somewhere to Wall Street side, and dollar for dollar was lost by investors. These products don't generate cash off of, creating iPhones. They're not adding anything to the economy. They're simply taking money from investors' pockets and putting it in their own through math. So if you'd like to follow along with that, as I just said, 1% of your portfolio allocated to shorting this product. The average, I mean, I'm not going to go through the math there, but just to let you know, this product's been around for 15 years and it's made 15-ish billion dollars for the issuer, with an average amount outstanding of $1.2 billion. So what's the rate of return on that? It's well in excess of 50%. So on average, you'll get over a 50% return per year by betting against this product, and it's math-based. So it's going to be very volatile because it's one product. Once again, I'd advocate if you want to do this over the entire issuance of all leveraged products. You'll be surprised. You can do the analysis yourself to see how profitable it would be. If there was a quarter that ever lost money, how many quarters did lose money? The quarters that you made money off of betting against these in proportion, how much do you make versus how much you lose? When you have that hindsight after doing the analysis or reading my book or discussing with anyone who has a mathematics background that will actually talk about these products, which probably isn't going to be anyone of any consequence, because once again, they're captured just like regulators are captured and politicians are captured. Their future, their pay, their future careers are based on not going against the grain. So I'm not constrained by that. So I'm providing my information for free to you, and you can do the analysis yourself. It's math, it's provable, it's factual. Once you go down the rabbit hole of looking at all these products, you won't be able to see anything else. And it's highly profitable. So it might be worth your time to do a little bit of checking and seeing if I'm right. It's logical, once again, that if Wall Street can issue something for 100 and have it redeemed or guaranteed to go down while investors play hot potato, and why advisors have it sit in defined contribution plans in hundreds of millions of dollars as it decays, with people who are working on assembly lines making $15 an hour, who are vastly dependent on their retirement as it's being gambled away. Hopefully this raises some anger. I'll share with you one of those defined contribution plans soon. And hopefully someone other than myself gets as angry as I do. It's not fair that smart people take advantage of people that don't have the power, the intelligence to know when they're being taken advantage of. So this is my passion. And over the past 5 years, I've proved myself more and more right in how I trade these things and how profitable it can be. So if you care to look into that, we'll be talking more later. If you want to follow along, I'll be doing this for forever. And then as time goes on, we'll expand this to other products and build portfolios based on some of my other models. This day late dollar richer is following the issuance. So it's basically matching. You're becoming the casino yourself. You're betting against these products and making in proportion similar to what the issuers make a day late, obviously. So the numbers aren't going to match specifically, but close enough. But because products are based off of mathematical principles, you can exploit them, just like a card counter playing blackjack. Card counters aren't trying to match what the casino's making. They're not trying to break even. They are trying to use mathematical probabilities for their benefit. So I've done that, published it, given it to the SEC, given it to journalists. It's out there. Now Wall Street is betting. Now some on Wall Street are admitting that the decay factor in these products can be used for profiting. It's a race to the bottom, in my opinion. I may not be 5 years ahead, but I'm certainly 5 years ahead of going public with this information. So I think it's me versus them on who can show the world how to bet against these in the most efficient manner. Here's one that takes nothing other than following the issuance. So go down that rabbit hole if you want. As I mentioned, my book is published. You can buy it for $10. Don't need the money, but need you to pay attention. So very cool stuff. Follow along if you want. I'll be doing spaces regularly. I'll be going live regularly. It's time for these products to stop hurting the regular worker who has no idea they have exposure in their 401k or your college endowment. So hopefully people go down that rabbit hole that have a louder voice than mine. I will keep screaming into the void by myself until someone does. It's an inevitability that these products will collapse over time, just like it was an inevitability that Bernie Madoff or Enron collapsed. I'm just one of the first to see it. Maybe not the first to see it. I'm the first to be public with it. So we'll talk later today. If you want to join on X, have a good one. See ya.